All right. Hi. Hi, everyone. Welcome to US Stock Tryout second session over here. All right. Great to have all of you joining us this weekend. Okay. So let's bring Jeremy on as well. Hi, Jeremy. Are you on?
Hi, everyone.
Hi. Great. Now, so glad to have you join us on our second session as well. So we have some of you who have already joined us. So if you are with us right now, can you just drop a note and a comment and say hi to us? All right, so we know who's joining us. All right, hi Vincent. All right, hi Uncle Fu. Hi BC. Hi Shani. All right, hi Muru. Hi Benjamin. Hi Irene. Hi Stanley. Okay, great. Now, so we have some of you joining us. We'll just wait a couple of minutes, and we have the rest of the community members as well as perhaps some of you who have shared the post. Your friends will be joining us in the session. Okay, today I think, Jeremy, would you agree if we are looking into what we would say as an undervalued company?
I think definitely we're looking at something that is at a very good price point right now. Yeah.
Okay. Yeah. So I think we do have something that's perhaps interesting and perhaps under the radar for most people who will be joining us. Okay, great. Now, so those of you who are already with us, hi Diva, hi YC. If you are already with us, can you do us a favor and just click on the share buttons, right? Because we're trying to do this as an outreach to let more people know about great stocks that they can invest in out there, and find out why a simple analysis, a simple approach can actually be done, and what they want to do after that, is entirely up to their choice. Okay, so we're gonna each session is going to be set up very similar. All right, that means we'll bring out a stock that we would like to discuss for the day. All right, Jeremy hates me if I bring out any surprises, so I'm just going to try to keep to one. All right, I'm going to keep to one stock over here, and then I would just come up with the storyline and the concept. All right, the concept of why we actually bring out the stock and what's the story behind the stock, why it makes it such an interesting one for discussion over here. And then Jeremy will start pulling out some of the numbers for all of you to understand. So we are pretty much doing what we call the fundamental approach over here, where we want to find out what's the story, what's the business all about, why is it good, and then Jeremy is going to come up with some numbers analysis over here, and then finally I'm going to come up with my comments in terms of how I would play it if I actually get into this counter, and of course Jeremy would join us as well. Okay, we might have a surprise visitor or moderator who join us after that as well. Let's see if they will jump in before we end the session. Okay, so as usual, all of you are allowed to ask questions, post questions. So please make sure you post them as and when you think and come up with them in the comment section. So I hope all of you have went over to the StreamYard website and click on granting StreamYard access. So on our back end, for me and Jeremy, we'll be able to see who's the ones that's actually asking the questions. Okay, so if you could do that for us, that'll be a wonderful thing. Okay, so just two things over here before we start once again. If you are with us right now, help us click the share buttons. Okay, all right, so the videos get shared out onto your feed over here, and then we'll be able to reach out to more people. Okay, and the other thing, second thing, okay, if you have joined us last week, you remember we said we're trying to find the right team, okay, for naming this particular session itself. So if you have not done so, could you just head over to my Facebook page, okay, my Facebook page itself. Okay, you would see that the post is already pinned to the top. Right, just leave a comment in terms of what do you think would be a suitable name for such a segment that we're coming up with, right, for all of you. Since Jeremy and myself have decided we did it for all of you, so we would rather have you actually name it, all right, and then vote it in rather than we come up with something instead for you. Okay, so name it over here and then share out the post as well. Okay, so that you can start gathering your friends to help you out in terms of liking the comments that you made, or actually seeing which one they really like, and let us know which is the most popular comment over here. We have some really witty ones over there as we've seen. Okay, so the comment with the most liked over here, all right, will be the ultimate winner. All right, that means we'll name the entire team over here using that particular suggestion itself. Okay, of course, the winner or the winning suggestion actually stands to win a live trading ticket over here, right? A ticket to a live trading event with me. Yeah, okay. Now, okay, so I think we're done. So let's get started over here. Jeremy, do you have the PowerPoints? Can you just fire up the PowerPoints first?
Yeah, sure. Let me just fire it up.
Okay, great. Right, great. Okay, now, so let me see if I can find the company first. I just realized I haven't brought up the company. A minute. Okay.
Terence, you want to do the overview first before I go through the numbers?
Yeah. I just wanted you to put it up. Then I realized that I should have gone through the overview, but I wanted to bring up a PowerPoint in terms of what's the company we're discussing. So sorry about that. I'll take over the screen itself.
That's fine. Yeah.
Yeah. Okay. Give me a minute. Let me set this up correctly. And then we're good to go.
So in the meantime, as Terence gets ready for the slides itself, right? Maybe just a shout out, right, for everybody, right? So if you're not joined our Telegram channel, do join our Telegram channel because this is actually going to be predominantly where we're going to post our updates there. Also, you notice that the inside the channel itself, whenever there's any sessions going on live, right, we actually will be sending reminders there as well as posting links there. So if you're actually on the go and you can't really figure out what's the link you need to click, right, you can actually use the Telegram channels link to actually easily access it as well. Yeah.
Yeah, thanks for the reminder, Jeremy. I think that's a really good thing because we sent out a notification on Telegram that we'll be going live today as well, yesterday night. And then we just sent out one couple of minutes ago, just in case, you totally forgot about it. So you'll be still, in time to join us for the session. Okay, I'm ready over here. So let me get the screen up. So once again, welcome everyone who have just turned in and joined us. All right, hi Shiva. Now, so our choice and our stop for discussion today. Ready, let's go. Right, today we're going to talk about this company called Kinder Morgan. Right, Kinder Morgan Inc. All right, now, so what is Kinder Morgan Inc? What do they do? All right, so I'll be starting to share more and go more in depth into this company right now. Okay, now, so Kinder Morgan over here is just about $15 stock right now, so it's not too expensive. So we thought this would be something interesting to bring about because sometimes when we bring about too expensive stocks, we have people who comment that, Terence, I really can't, get myself into that opportunity. It's a little bit costly. Can you bring about some of the lower end stocks? What we're trying to do in this session is not so much in terms of putting a price tag on the stock, but trying to dig out undervalued or growth opportunities, or as well as fallen angels over here, where we are trying to take a view, all right, and then of course share our thought process behind it. And Jeremy goes into the numbers, and then before deciding how we want to trade such an opportunity. Yeah. Okay. Now, so the first thing to go over here is really to find out what the company actually does. Now, in case really just in case most of you have not actually heard of this company before, so let me share with you my end right now. I prepared kind of a short pointer view over here. If you've not heard of Kinder Morgan Inc., all right, it actually is one of the largest, in fact, I would believe it's almost the largest right now, energy infrastructure company in North America. All right. In fact, it doesn't deal with oil. All right. Many people think it deals with oil. All right, but it actually isn't, because it's actually the largest operator of natural gas transmission pipes. Okay. So what they have over here is their infrastructure. When we say it, right, is in terms of all the pipes that are laid out all underground right now. Okay. All right, and they transmit natural gas across the country itself. Okay, now, and it's also the transporter of what we call petroleum. All right, they transport petrol as well, and of course, carbon dioxide gas as well. All right, and they are all concentrated around North America. So they're the biggest, independent operator of this particular commodity project. All right, terminals over here in the North of America. So when we say product terminal, all right, it basically means like a warehouse over here for these commodity stocks. So, people store goods in their warehouses, but, these pipelines over here, they store what we call all these gases over here, right? And, start to deliver them when the demand comes in or when the order comes in, right? So this is what Kinder Morgan does over here. So you can think of pipelines, right? Pipelines as, a really cash cow business. Right, cash cow business, because it's somewhat like your utility companies, all right, where they supply all these utilities to family, homes, businesses, offices, and right, in exchange for those monthly payments, monthly subscriptions. So, this will probably be more like tuned towards a B2B end in the perspective of things. So pipelines over here are, natural market dominators because it's a very simple reason. Nobody wants a pipe running through them. All right, which means once a company has a pipe underground that's running through estates, running through areas, running through cities right now that have already been built on top of it, nobody wants to lay another pipe under them. Yeah, all right. Okay, so for this reason over here, the first one that is built in the area, right, it's usually the one that's going to stay. Because most of the time, if another company comes in and say, "Oh, I want to start laying pipes and everything," it starts to face a lot of opposition when it comes to this. Right, so environmental issues and blah 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 blah. We have probably seen some movies going along these lines as well. How much harm it does to the area, the environment, and stuff like that. All right, now, but this is a necessity. So obviously, the first company that gets their hands in terms of all these pipelines running through a particular area and estate, right, they are the eventual winner. Right, that's also one of the reasons why such a business is really a cash cow business over here. Yeah, all right, now, so existing KMI, that means KMI owned pipelines, right? So basically these existing KMI pipelines that they have are basically almost zero risk to new competitions, right? Zero risk because, it's so hard to get in place. So many companies won't even want to try that because some of them were tried many years ago, realized the difficulties. So it's as good as throwing money down the ocean. So, once they see someone is already running pipes in the area, they just leave it as it is. Nobody's going to come in and compete. Yeah. All right. Now, so let me see this as well. So this basically allows, all right, KMI to keep their revenues, all right, and cash flows in a very steady environment. Yeah, okay, all right, a very predictable kind of environment. Now, roughly 66% of KMI's cash flow come from, what we call take or pay contracts on natural gas and liquid pipelines. This basically means that, KMI is entitled to payments even if the buyer doesn't take that amount because it's already committed. Yeah, all right, it's already committed. So whatever is being committed, KMI is expecting to get paid for those amounts over here, right? So whether you use it or not, it doesn't really matter, right? Because you are basically like a subscriber, all right? So it doesn't matter how much you use at the end of the day. All right, now, so a lot of these contracts, range from 5 to 14 years. And then, of course, we have those long-term contracts as well. So, of course, they're up for renewal. But once again, right, if you're the only pipeline running through the whole particular area itself, then nobody's really got a choice after all. Right? It's like a kind of like almost market domination, but not because the company wants to dominate, but simply, the competitors don't want to come in, right? Because of, the high barriers to entry. Yeah. Now, so basically 6% of the cash flow, 6% of this cash flow over here is hedged against the commodity risk exposure. All right. Now, I think this is very prudent for KMI's KMI's management team to actually do so, because if you pay attention to natural gas, all right, natural gas, if you have heard that natural gas trading has been, one of the main culprits in terms of wiping out some entire brokerages because of losses made by some of their traders. All right. So, it's a very, very dangerous kind of product. Right now, it's not dangerous kind of product, but during my days as a trader in a proprietary company, right now, so what I used to do was, we actually started talking about trading natural gas, but after one or two ins and outs over there, we decided that we will lay off this product totally, because futures contracts are traded in what we call contract sizes. Okay, and contract sizes for natural gas is actually $10,000, like a 0.01 move. Yeah, all right, it's worth $10,000. So can you imagine if natural gas prices really move by $1, all right? The contract value, profit and losses is substantial enough, all right? And if you're trading too large a quantity over here, that's why many of these companies actually get wiped out, because losses can accumulate really, really fast, and the contract size amounts make it really, really huge. Yeah. Okay. So it's a good one over here that company actually borders to hedge some of these pricing risk over here. Now, so basically, down to this steady and reliable nature of KMI over here, right? It basically makes sense to think of it and adding, some exposure to it in your portfolio, right? How will you play it over here, right? I would really say I'll play it in two particular ways. One, if you're in this for the long haul, all right, you probably want to acquire some of the stocks. Okay, I'll share it more towards the end. Okay, but if you are more in terms of the short haul over here, you have to think of ways where you can profit from it without expecting too much capital appreciation from these counters. Not that it can't, all right, but it's probably one of those where you look at slow and steady over here. Yeah, all right, that's my perspective. Okay, all right, now, so one of the best part over here is this. I find it really, really interesting, and that is this, right? That, most of the time when you invest in companies, the fundamentalists will tell you that, hey, you want to invest in companies where the management of the company is actually in line with the investors. That means, the thought process of management over here should think about the investors at heart, all right, with every decision they make, right? And you'll be surprised to find out that, the CEO and the COO, right? Okay, I think it's the CEO and COO. I'm not sure or it's just one of them, right? They're actually only drawing a salary of $1, right? They're drawing a salary of $1, right? So where do their money come from? Their money comes from the stock ownerships that they have in the company. Yeah, right. Okay, so basically, if the stock performs well, they make more money, right? So because their annual salary over here is really just $1, right? So we know that even Buffett draws six-figure salaries a year, right? But these Kinder Morgan partner CEOs over here draw like $1, right? So I think that makes sure that they really have the company's interest in heart and investors' interest in heart with every decision they make, right? So over the years, what they've done over here is they're trying to build what we call the toll bridge. Now, why do we say the toll bridge? Now, many of us may not be familiar if you're from Singapore when we say the word toll, right? Okay, but in Singapore we call it ERP, right? But in Malaysia, if you're joining us from there, all right, or directly from America, then you'll be very familiar with this thing called tolls, right? Even in Thailand, right? So every certain part of the highway over here, where you cross it, you get stopped by a gantry, all right, and then you make a physical payment, all right, before you move ahead to the next segment of the road. So, this is where, the governments or whoever the company has built the bridge on starts to collect all these money that they've spent building the bridge over here, right? But eventually it becomes a profitable business. Yeah, okay, all right. Now, so think of pipelines as something that's similar to these kind of toll bridges over here. Right now, so I think because of all these reasons over here, I really, really like, what KMI represents over here. So in fact, all right, I have been invested in it for quite a while, way back then, right? But it actually announced a dividend cut. All right, I think it announced a dividend cut a couple of years ago. Let's go take a look over here. Give me a couple of minutes. All right, now, so you can see that it was increasing their dividends over here, and then it made quite a massive dividend cut in 2016 over here by about 2/3. Okay, but they've since gone back to their regular plan over here. Now, so because of these reasons over here, they are what we call a very cash flow based stock or very income based kind of investments over here. And while they cut their dividends, you see that their sales revenues were kept actually very, very steady. Right, very, very steady over here. And one of the best parts over here you can see over here is their gross margin of the entire business remain really, really high. Yeah, all right, really, really high gross margins for the business that they're in. So what the company has done is over the years they spent more and more money, all right, acquiring pipelines across the entire America itself. All right, so they started as what we call master limited partnerships. It's kind of a way that a company can be set up in America to avoid tax payments. Right, so in order to avoid tax payments, what they need to do is they need to pay out all their profits that they make as a form of dividends to investors, right? As a form of dividend to investors. So as you can see in their earlier days, as they start to make more and more money, right? That's the reason why their dividend payments are actually increasing, right? Okay, but if I'm not wrong, in 2016 they actually changed, or Kinder Morgan or KMI started to acquire, right, the MLP company itself, which I believe was called KMP. All right, so because of that, KMI is not one of those master limited partnerships anymore. Right, it's more functioning like a limited company or investment company, which owns a big portion of KMP. Yeah, all right. Now, so because of this reason, it may be because of dividend cut, but you realize they're starting to put the right measures back in place again. Yeah. Okay, so this is my story from the story front and from the angle front. So I'll pass it over to Jeremy. All right, so Jeremy will get in touch with all of you right now to talk about numbers. And then, of course, both of us will come back later on to answer some questions and then bring about some of the plays that we can look at over here. Right, on to you, Jeremy.
All right, thank you, Terence. Thanks, everybody. Yeah, so maybe just let me just go straight into my slides, okay? Let me just put it up again. All right. Okay, welcome. So let me begin. Before I begin, right, I just need to do a very quick shout out again. We need a name for this segment. So really do go to Terence' Facebook profile page and then just leave a comment in the post and then with the name that you're going to suggest. And then you get your friends to come in and then just do a like on the comment with your suggested name. That way we know that suggested name is going to be the one that's going to be most popular. And then we will finally have the name for this segment. All right. Okay, so let's go straight back to KMI. All right, so KMI, just as a refresher for anybody who might have missed out on the profile earlier shared by Terence earlier, it's actually one of the largest mainstream energy firm in North America with a focus on natural gas pipelines, and it's a focus on oil and refined products pipelines. Now, it's actually in the business of transportation, storage, processing of natural gas, crude oil, refined products, as well as natural gas liquids and carbon dioxide. Now, the majority of these cash flow actually stems on fee-based contracts for handling, moving, storage, and for fossil fuel products. Now, I'm going to share in a way of how I actually look at this, the numbers for this company. In the whole timeline is about 10 minutes when Terence shared this, told me to look into this company. So while you're looking at the slides, right, in terms of like, oh, this looks very tedious, right? The whole process only took about 10 to 15 minutes time. Okay, right. So let's go straight in the numbers. Okay, so in the trading return for the KMI against the industry from Morningstar, all these slides, all these screenshots are taken from Morningstar website. We notice that this company KMI is actually trending very near, but actually in a way better than the industry. Now, if you see, for example, 3 years ago, right, starting from 3 years ago, KMI is actually performing at about negative 2.78% for its stock returns. Whereas for industry-wise, we're looking at about close to 10%. And then the last year to date, well, because of COVID-19, we know that there's a change in the market dynamics, but KMI is performing minus 25%, whereas for the, his other competitors in the industry, we're looking at about 30% down. So this is a company that is like slightly edging better than industry. Okay, and then we see at the book value levels for the financials. Now, under the book value, I like to focus a bit on the price book value, how much we're paying for the book value of the company. It's almost at its book value. It's as good as you're paying for the company right on its book value, right? So if you're not very sure in terms of book value, what does it mean, right? You can actually head down back to the our Telegram channel. There's a stop link over today on price book value ratio. So you can look through and see like what does it mean, kind of thing. Yeah. Okay, so let's go on. Now, under financials, we're looking at the last 3 years growth, right, for the annualized return. We notice that they are generally on a positive growth for the last 3 years. This is a good sign because we want a company that is growing and it's going to give us future returns, a project of future returns, right, for our for other fellow stock owners, right, to actually believe that this company prices will go up. And then also, the thing is that despite all these very good news, right, we're looking at a short-term liquidity ratio that doesn't seem very ideal. It's actually less than 1. If you ask me, I would prefer that it be more than 1, but we can actually examine it slightly later. Yeah, so the short-term liquidity ratio is quite meh. Whereas if we move into the interest coverage ratio, which is how much you need to pay, right, for interest, typically the benchmark is about 1.5 plus minus, but looking at 2, right, it means that they can cover about 2 years worth of their interest repayment, which is a good sign because it shows that they don't have any problem. Let's say, for example, they need to service their loans in a way. Yeah. Also, these companies are based on the snapshot from Morningstar. It shows a very high level of debt. Okay, so up to this point, you're looking at a company whereby it's a bit of a cha-cha. Some things are good, some things are bad. Okay, so then slowly you just move on again. So this is also training or process, like you slowly keep track of the things that you need to look out for. And then at the end, you form your own view of the company based on maybe the overall look, as well as whether there's any possibility of a trade they can structure. All right. Now, also, company now is profitable. So we're not looking at a company whereby it's making a loss, and then we don't know whether they will be profitable or whether they will be eventually profitable. It is profitable now already. Okay. So this company's business model, when it's already profitable, it shows that they don't have to prove again to see that their business model works because it's already working now. Okay, we just need to make sure that it will work on consistently in the long run. Okay, moving forward, we look at the income statement of the company. Hey, we know that this company, right, has a very consistent operating income. Okay, operating income is very important because, right, we generally do want to be faced in a situation whereby companies that try to inflate their numbers by one-off sale of assets, one-off returns in terms of other activity, other cash flow and activity, right, affecting their overall income. So we try and make sure that the operating income is consistent, and then that should translate into a consistent net income itself. For this case, right, KMI has shown that it has an increasing net income right, since 2017, all right? And also because of that, right, the normalized earnings per share, EPS, is also positive since 2017, okay? Now, on to the balance sheet, right? This is a very mixed sentiment here that I noticed. On one hand, right, we notice that across the assets portion of the company, it seems to be on a decline. Whereas at the same time, right, we also know that it's also reducing their own liabilities and debt. Okay, so maybe not so bad. And there seems to be like a slope, kind of like a negative decline in terms of the equity for the company. So that could still spell signs for concern. But if you also see right later when we balance it, right, we notice that the cash flow, the operating cash flow, which is hardly linked to the operating income, the operating cash flow of the company is actually very solid. Looking at close numbers, but 4.6, above 4.6 above, and then it's kind of like doesn't really fluctuate much. We need it there, and then as well, right? We look at free cash flows that's actually improving from 1.41 in 2017, and then eventually in the 2.48 in 2019, and then 12 months, right? Even though there is the COVID-19 situation, it is actually still improving as well. Okay, right? So this company, right? If you look at other ratios, other be it like price earnings, price cash flow, price book ratios, right? Against its 5-year average, right? They're actually generally cheaper. All right. So you see that they're consistently lower. And then at the same time, right, we see that the performance ratio, which is the return on assets and the return on equity here, return assets, return equity, they're actually performing better than their 5-year average. So it's like a company that seems to have figured a way whereby they're not just making money, but they're making money better with a higher higher margins in a way. Yeah, so beneath at the bottom here is actually showing the margins, current trailing 12 months margin versus the 5-year average margins. We want this to be higher than the average as much as possible, and we show that actually it's actually improving across the board. Okay, so where does that leave us? Okay, see, in terms of the dividend for this company, exception from the time in 2016 where they cut the dividends, like what Terence mentioned earlier, the dividends has been maintaining increasingly. All right, so that means increasing slowly. Yeah, but the thing is, right, we look at the payout ratio, it's very high because it's actually more than 100% currently. So it could be due to the the income that they're going through, or the could be due to the dividends. But if you examine it, right, you're going to see that the dividend policy didn't really change much. We're not looking at like a 100% jump, the kind of thing that, or 70% jump. It's actually more of like close to 11% increase from 2019 to the current date. So that shouldn't be due to the dividend, but it should be due to the earnings which could have been impacted because of the current market situation now. Okay, and also we're looking at yields currently that's better than the 5-year average. Now, actually, when I look at dividends and we see these, right, there will be, you might have heard of this concept called the value trap, dividend value trap, as well as in value investing, there's also this term called value trap, whereby, right, if you are investing in companies that is very high or very good in terms of value, and yet they don't move, right, you're just basically having money stuck there. Okay, so what we can do is we can actually use options, right, for us to actually mitigate that. Okay, so what I do is I actually went into my Thinkorswim platform under the fundamentals tab for KMI. I look at the book value of the company. We're looking at about $14.90 based on the calculations from Thinkorswim. And then, right, I just have an understanding of by $14.9 is the company's worth in terms of book value now. And then we look at option chain. Okay, August standard expiry for under the put spreads. So if you haven't realized, right, I'm looking at this of like whether this company is actually able to sustain the stock price. We're looking at maybe $11 to $14 thereabout. Okay, and when I extrapolate the data out, right, okay, and we choose a strategy called cash cover put, which is the simplest way to generate a return using an option in a way. Yeah. So if you're not sure in terms of what is cash cover put, you can actually go back to Terence' Facebook page and look through the project option cash flows portion, the sharing on cash cover put. All right. So you just need to scroll through that. Alternatively, you can actually look into our Telegram channel, look for the day that we mentioned the cash cover put as well. Yeah, I'll put up a link at the end of this session for refresher on that. Okay, now very simply, how we look at this table is under the TMI 21st August standard expiry for $11 to $14 put. Okay. Now, we will need 100 shares per contract. So we're looking at about 100 times the strike price for the deposit requirements. And I'm using purely based on the bid price. Okay. This presumption is that, okay, I'm receiving a very low ball offer for options I'm going to sell. Okay. So this is to keep it simple that we're not looking at maybe the bid ask, how am I going to negotiate. Now I'm just going to assume on the lowest amount of premiums I can collect. Okay, so on every dollar return, right, we're looking at about 0.64% for this trade. If you're looking for $11 strike put, okay, and for the $14, we're looking at about 3.43%. Now, for some of us who like to look at numbers on an annualized manner, right, we're looking at 4.73% for the $11 put strike that you sell for the cash cover put, and for $14 put strike, you're looking at about 25.47% annualized. Now, how you're going to look at this is, let's say, for example, the company really goes south, the price goes south, and you have no choice, but you need to take over the stock because you're doing a cash cover put, right? You're going to pay $10.93 if you sell the $11 put, right, per share. Meaning, you will pay out of pocket after factoring the premiums you collected, $1,093 to collect the 100 share for the company. So if you actually put a comparison against the book value of the share, right, you're actually getting at a discount, further discount than what you're looking now. Okay, so I think for me, when I look at this, it was actually enough for me to make a decision that I'm looking at this trade, how I'm going to structure it when market does reopen on Monday, because I just did this early this morning itself. Came out, but just as an add-on, because here at IMP we always do add-on, we always train, overtrain. So what we're gonna do is I'm gonna introduce this concept by looking at the implied volatility cone. Okay, now, for some of us who may not have heard of my last sharing in the project option cash flow on implied volatility, how do you actually choose when to sell, when to buy, in a way, by virtue of the volatility. Now, implied volatility cone, right, is a very simple concept. Basically, there is always upper range price and a lower range price, right, at any date, any point in time, right, by expectation. Now, don't need to understand the full concept, just need to know how to apply, okay? Now, it means that based on the price as of closing for last Thursday, there is a 68% chance or 2/3 chance, right, that the price of the stock will fall within this cone. Okay, now look at 21st of August, which is this part, okay? The price at the cone is about $12.62. Meaning to say, right, if based on statistics, okay, right, there is a 68% chance, right, the stock price may land between $12.62 and $17.33. So how do I use it? Okay, so I just need to make sure that when I am selling an option, be it I can sell it at a strike price that's lower than that if I'm choosing the August expiry, or I sell it such that the break-even price, this part, okay, is lower than the $12.62 that is by a statistical chance of a structuring trade, right? Then I will have a very good chance of being out of the money come to expiry. Okay, so that way, right, we can actually structure the trade in this manner. Yeah. So actually, with that, right, I mentioned what we're looking at is actually a company that's damaged because we're looking at dividend cuts, I think sometime in 2016, and it's really recovering very well for an industry that's relatively volatile. And the thing is that in order for you to take this trade, you must be willing to own the stock for a long, long time, very long time. We're looking at very long term. Okay, so with that, right, I'm actually done with the sharing because this is a 10-minute job. Any questions for you guys?
All right, great, Jeremy. Thank you for sharing. So all of you have heard Jeremy's numbers analysis, and then after that, of course, you know the trades that he'll be taking. But I think Jeremy is only highlighting cash secure puts, right, Jeremy?
Yes.
All right. So Jeremy's driving on the naked put strategy, all right, for portfolios over here, all right? Naked put strategies for portfolio-based type of option selling. All right, so does anyone have any questions for Jeremy? All right, this is the time to post it up in the comments. Okay, otherwise, Jeremy, let me take over. My turn.
Sure.
Okay, all right, give me a minute. Let me launch my brokerage platform. All right, Jeremy, you want to take the answer from the question from Uncle Fu, EPD?
EPD, he's referring to the company EPD?
Yes, basically KMI versus EPD.
Well, I haven't actually looked at EPD numbers in a way, but if let's say we were to look on isolation, right, I think for KMI itself, I'm fine with taking a trade on its own. Yeah, so if you're going to do EPD, right, I think you can do something similar in terms of how we look at it, and then like maybe structure something that is meaningful in a way. One thing to note is that if, let's say, for example, we're going to do this way of analyzing, right, one of the challenges that when we look at the options, right, some of them, they do have options, but then the options bid-ask pricing, they are not meaningful because they're too wide. And if you do a covered strategy in this manner, right, you are really, really shortchanging yourself to close to getting dirt for the dollar. Yeah, so if I can just fire out my trading platform to have a look at EPD, let me just do that. Yeah, give me a moment, Uncle Fu. I go back to you.
Okay, all right, no worries. So Jeremy, while you take a bit of time to look at EPD, I'll just talk about my suggested play for KMI.
Sure.
Okay, all right. So all of you are now seeing my brokerage platform itself. So what I want to do over here is I just want to start off from the charts. Okay, I just want to start off from the charts because we all know how the fundamentals look like now, right, for this particular company. So same thing as what Jeremy did over here. I want to have what I call, a rough-based analysis on, what my risk is and, what am I looking at over here. So right now, let me start from a daily chart, which stands for about the last 3 years. All right. So what we can see right now is if I take a daily chart from the last 3 years, and I draw out the lowest point over here. Okay, the lowest point happens to be somewhere around 1470 right now, and this is why you see that when this particular stock went or got driven down by the COVID crisis market crash, all right, and then after that when it quickly rebounded, all right, it just went all the way up, right, but when it did a reversal over here, it actually bounced off this support. Right. This is how technical analysis works because it works on a historical basis, and then the probability of people coming in and people stepping in. So if you were a trader, right, you would know that this was a past support level. So since it's broken through over here, when it comes back, right, it should bounce up from this support level, right? And this is where in the recent time over here, you could see as I widen it up. Oops, sorry. Right, it's actually valid. Right, it's actually valid because it just traded around at prices over here, and then we had that one inside day. All right, and then after that, the trend changed back up again. Now, so what I would say with KMI is this. All right, it got unnecessarily hit. All right, by the crisis period, and on top of the crisis period, it was also unnecessarily hit by the oil issues. All right, so we all heard what oil did in recent terms. It went negative. Right, so many people associate natural gas together with oil. All right, so naturally when oil prices really went crashing over here, there's no better way to put it. It's just a crash. Right, so a lot of natural gas companies got affected as well. So of course KMI definitely got affected, and even the other stock that Uncle Fu mentioned over here called EPD, right, it got affected as well. Right, in the same period. Okay, because EPD deals with natural gas as well. Both are, I would say, are very, very similar like-for-like companies. All right. Okay. Now, so in terms of which one should you do over here, it all depends on are you willing to stay concentrated on one particular stock, which means are you going to be more confident with KMI or are you more confident with EPD? All right. That's down to the own analysis, of course. But if you're mixed between both, I would just say you can always split 50-50 of your allocation into each of them. Because you would see from the charts over here, all right, now you're looking at KMI, right? And then I'm just going to quickly swap over to EPD. You'll realize they look exactly the same, right? But there's a slight difference in the sense that if I go with KMI, right? If I go with KMI, you realize, okay, I will be trading off, a long-term support where the stock price is right now. So in case it turns down again, I can quickly cut the position if I'm trying to trade it. Okay, if I'm investing in it, then it's a totally different story. Okay, but if I'm trading it, then I would think that KMI will be a better opportunity from risk perspective as compared to EPD, right? Because the same 3-year chart over here, but for EPD, right, the support was actually way back at around $23 before it broke down during the COVID market crash itself. Okay, whereas for KMI, as you see again, right, there were support levels that are sitting much closer to where the stock price is today. All right, so from a bounce up situation, like a bounce upwards, right, or a capital gains play, I think KMI would present a lot more potential because it's bounced off, a bottom over here. And if it really starts shooting up and breaks past I would say break past this point over here of about $18, all right, it could actually re-challenge the high that is made before the COVID crash at 22. All right, now why do I say this? Because you will probably be seeing the neckline of what we call a triple bottom. All right, triple bottom simply meaning 1, 2, and then there's the third time. All right, so if a triple bottom, typically you'll say that okay, it's going to bounce back up to the neckline over here. All right, but if it breaks the neckline, then you expect a similar range movement after the breakout, which is 14.7 to about 18 point. Let's just round it out to 18.7. So a $4 move. So you see, if you add $4 from 18.40 upwards, that'll be 22.40. So that's exactly where the high was before it came down. All right, so I think IMP grads, this is probably the most intense time you'll see me starting to talk about all the charting terms and names over here. All right, but yeah, I'm just trying to give you some perspective in terms of how do you look at trading plays. Okay, all right, trading plays. That means if you want to trade it. Now, trying to kick it back a little bit shorter term over here. If I change the timeline to a 1 hour chart, what we'll see over here is from the bottom last week. Right, from the bottom last week, you start to see established upwards trending line over here, but it's kind of like a flag as well, right? A flag as well. Yeah, all right. Okay, maybe not so much a flag, but a trending channel over here. All right, back on the upwards, and it has also broken the high over here, right, which is sitting around $15. Right, so it broke up from here, right? As you can see, a sharp breakout hits the resistance level, and then it's now coming back. Right, it may come back to this resistance point or maybe to the bottom of this uptrending support line and then start resuming upwards again. All right, so I would say if you look at the charts right here, right, there's 2 ways to play it, either from an investment perspective or from a trading perspective. Right, so if you're from a trading perspective, I think this point right here, right, will be a very good point where you can start to look at selling some short-term put spreads. Okay, put options or put spreads, either way. Right, it could be a naked put, it could be a spread. I leave it entirely up to you. Right, and then where do you want to take your profits if you get a quick good up move? Right, you probably want to take it at the top end of this channel over here. Right, so every time it goes towards the top end of the channel, you realize, okay, bounce up, comes down, bounce up, comes down. All right, I'm not saying it can't break out, right, but that's the point where you may want to take at least 50% of your profits off the table. All right, okay, why is it 50%? Because it does have the ability to keep bouncing up all the way to this next high over here, which is around 1580, 1590. Yeah, okay, and if it breaks above that over here, then you'll start to challenge this one over here at 16, and then of course the next one at 1640. So there are multiple levels over here. But I think once it can break 1620 or so, right, then you expect the next technical concept of filling up the gap, right? Because the stock did get from almost $17 to 1630 over here. Right, so if it fills the gap, then you could easily start seeing, KMI start trading to $17 level. Okay, all right. Now, so before I go to the trade suggestions and different trade ideas over here, anyone with any questions you want to add on?
Right,
Okay.
Terence, actually, meantime, while the everyone's actually typing in their questions, right? Maybe let me just answer Tanker Fu's question. I have an answer already, right?
Yeah.
Okay, so I actually timed myself. I think it took around 6 minutes to look at it. So yeah, that's actually in line with what I'm trying to do, which is to do an analysis within 10 minutes. Okay, let me just share my screen here. Just a second, yeah. All right. Okay. Let's see. Terence, can you see my screen?
Yes, I can. Yeah, go ahead.
Let me see. I think it's not showing on the stream. Give me a second.
Yeah, it is. I'm seeing your trailing returns.
Oh, okay. Yeah.
Yeah.
Okay. So basically, what I'm trying to say, okay, for this, right? Uncle Fu, I would say, right, if let's say, for example, today you have shown me EPD before I look at KMI, right? I would think that the EPD is actually a very decent trade. But your question is asking me compared to KMI, right? So I would say overall, I'm preferring KMI better than EPD. Okay, why is because of two reasons. First thing is, right, on the quarterly trailing return rate for APD against the industry, right? APD is just trending very, very closely against the industry. Whereas for KMI earlier, I showed that while it's trending very closely, right, it does have a slight edge against the industry in terms of performance for stock return. Okay, right. The second reason, right, is actually just purely based on the price book value of the company. Sorry. Yeah. So we mentioned that KMI is trading about 1.03 to its book value. All right. Whereas for EPD, we are looking at about 1.56. So if you ask me to compare apple in terms of these two parameters, right, I would just prefer KMI better. And furthermore, I look at the EPD in terms of being a swing platform. I don't think that I could structure anything really, really meaningful in terms that gives me a healthy return, right, for the stock as compared to a KMI trade. So actually, my preference is actually with KMI in a way. Yeah, but this is a very good spot in terms of on its own. EPD it's kind of like okay company to actually go into as well. Yeah.
Okay. So, Uncle Fu, any add-ons to what Jeremy mentioned? If you can, you're free to grill him. All right. While we wait for Uncle Fu to reply, let me just answer Hian Tuan's question over here. Since it's an energy company in terms of portfolio management, how much would you expose the risk, assuming that KMI is the only energy that you're investing in the portfolio? Now, typically over here, we could stick to the. Let me put this to perspective. Typically, one of the better risk management strategy is definitely not to over allocate in a particular stock in your entire portfolio. So let's say if you decided to have a portfolio of 10 stocks. So typically each stock will represent about 10% of the entire portfolio. You could also go to 20 stocks, and that means that each stock should represent 5% of your portfolio. Now, so let's say if you go with 10%. Now, I would say that for KMI, although it's a commodity related kind of stock over here, but if you believe in the fundamentals and you believe that, the whole idea of pipelines, okay, pipelines is a difficult business to break into, okay, and no matter how you say it over here, their main product is really natural gas as well as carbon dioxide and a little bit of petroleum. So yes, while we may start seeing things like Tesla and electric cars and stuff like that hurting petroleum, but pipelines are still required. All right, so pipelines are already built. All right, their expense are being recovered each and every year with all the contracts that KMI and even EPD, I think they're similar. All right, are operating in. Okay, so I would see them more a little bit as a utility-based company. All right, I'll see them more in terms of a utility company rather than a pure commodity play. All right, so if I'm really building a portfolio and I'm happy with the numbers I'm seeing, I would probably start with 5, right? I start with 5% half exposure. And then, if things work out, I start to lower some of my cost basis on the original 5. I may actually be willing to expose up to 10. So I would say it could go up to 10, but definitely not immediate. That means not on the initial entry, possibly on added ons up to that mark over here. Yeah. Okay. All right, Kentuan, I hope we got that right over here. So Uncle Fu brought about another question over here. Yes. All right. Yes. Let me address it, and then Jeremy, you can come in as well.
Yeah, sure.
So Uncle Fu, do understand that for any of these kind of things, that's why, like we said earlier, right? When it comes to laying pipelines, definitely you're gonna have these issues. Right, all these environmentalists are going to come out and tell you why you should not dig this ground over here. You pollute this, you pollute that. But it's always a weightage between necessities, right? Necessities and the environmental damage. So this is also one of the reasons why. The first companies are always going to get the upper hand, because the first companies, yes, it's going to be a difficult process, but they will have justifications to get it done, in terms of economic viability, or why there's a real need to cut that pipeline through this particular place itself, right? And they can go to courts and actually get it approved. But the second company to come and say that they want to lay the second pipeline, then these environmentalists are going to come hard on them. Yeah, okay, and judges will find it harder to justify approval for a second one as well. Okay, against these kind of pressures. So I would say that yes, it's definitely going to have such issues. Much like if you choose to invest in Philip Morris, right? You'll probably see all these lawsuits that people will put up just because they got they got all these sickness from smoking and stuff like that, right? But you have to understand that they were the ones that made the decision, right? They were the ones that made the decision, and they can't really blame the companies, because that the product is harmful before you got started. So likewise, if a city council or state needs, that natural gas to get pumped into their area, and the only way is to, or the most cost-effective way is to start to allow companies who are willing to spend the money to build pipelines, that will lead to that particular state or city itself. I think they're more than happy to do that, right? They're more than happy to do that, because somebody is spending the money, all right, and then the city council, or whatever city itself, is able to start acquiring these kind of necessities over here at a much cheaper price than if they have to get trucks out there to transport and then get them to their city itself. Yeah, okay, which obviously I'm not an expert with natural gas, which I don't really know if it's possible as well to transport natural gas in this particular manner, all right, apart from pipes. Yeah, okay, all right, now, so it is definitely something like a challenge, but I think let KMI does what it does, because it's been a company that has been laying pipes and buying pipelines for many years now. And actually, to be okay, sorry, Jeremy, let me steal the light for a little bit. Okay. Right, it's actually very interesting. Okay, very interesting if you found out the background story behind this company. Right. Okay. Why do I say it's interesting to find out the background story behind this company? Let me share with you a little bit that I know about. Okay. All right. Give me a minute. Let me find that particular facts over here so I can bring it about to you.
Anyway, just as an interlude, right? Okay, so Benjamin, I have a response for PBA. Let me just share that in a little bit later when we answer Uncle Su's question. All right. So actually, to say in reference, right, the time you asked this question is 4:53 p.m. and I already have a view for you at 4:56 p.m. It took about 2 minutes time. So actually, the thing about what I like about using fundamental analysis in the options trading strategy is that because of how the contract can allow us a certain level of margin safety, right? We don't need to go so deep like what other fundamental analysts do when we need to calculate or look at a company from a fundamental point of view. Yeah. So in 3 minutes, I have answer for you, but let me just answer you later so that we don't confuse the other participants. We just focus on Uncle Su's question and concern first. All right?
Okay, great. Now, so this is why we want to do such a session, because I think that by doing the deep dive over here, a lot of you can find out more about these kind of companies. So I'm going to share with you something out of the blue, out of the context, because it's being brought up. But if you find it really interesting, let us know. Okay, let us know in the comments over here. All right, it's something valuable, and you like actually to hear such things over here. All right, so that I know that I need to prepare myself for these kind of things. All right, now, so Kinder Morgan, all right, they actually started out in 1997. Right, and they started out in 1997, right, as part of a company, right, that actually was the biggest scandal, all right, biggest scandal in the whole entire energy industry. Anybody knows what that scandal is in 1997? Yes, I'm testing you. Anybody
Was
want
it the oil
to
leak?
comments over here in terms of what do you think the scandal was? Let's see. Nobody. 1997 scandal. Nobody. Jeremy, do you know?
I don't know. I was not even 12 then.
No. Enron. Enron. Right, I'm sure everybody knows Enron. Yeah, right. The Enron collapse, right? The whole scam, the whole financial, kind of issues over here. It was one of the company that went bust. All right, so it was a highly successful and loved energy company, but it went bust, right? Because the leaders of the company were charged then with conspiracy, insider trading, and of course fraud as well. So the CEO and the CFO actually ended up, serving prison time. So, of course, the founder, if you have heard, actually died of heart attack before being sentenced. Okay, now, so this scandal actually really shook the entire Wall Street itself. And, actually what happened was the owners of Kinder Morgan, which is actually Richard Kinder and William Morgan, is actually two partners' names over here. Right? They actually got away from this entire debacle because they left the company. They actually left Enron just as the criminal parties over here were taking over. All right, so they left, and then these new guys came in, and then the whole scandal started from there. So Kinder was the Richard Kinder was actually the COO of Enron, all right, until he passed the helms, all right, in 1997 to this other person. And actually, he had a name or a nickname over here. It's called Dr. Discipline. All right, because his cost control prowess over here, all right, was simply amazing. Yeah, all right, he was really, really good at this. Okay, so while he left Enron over here, the person that took over from him, I think his name was Jeff over here, is the one that is now serving, I think, like a 14 or 15-year prison term. Okay, now, so in 97 over here, Kinder and Morgan, the two partners over here, they actually bought over, right, this Enron liquids pipeline company. Right, so when Enron went under, right, so what happened over here was these two partners over here, as they left, they used some of their severance package over here and invested in this particular pipeline, right? So they bought it for 40 million, even though that the entire assets were valued at like 325 million, right? And from there, right, they actually changed this pipeline name to what they call Kinder Morgan Energy Partners, which is KMP that I mentioned just now. So they started to set up KMP as what we call a master limited partnership. And many of the investors, right, they actually thought that, is master limited partnerships is just like an income kind of based investment, because all you wait for is dividends that a company pays, right, for the profits that they make, right? But these two guys have a much bigger plan on here, because by structuring it this way, right, they actually, don't have to pay corporate tax, and they get to lower the cost of capital, right, as required to non-MLP kind of setup over here. Yeah, right. Hear me correctly. I said MLP. I'm not NLP. Okay. Yeah, I'm not trying to brainwash any of you. Okay. All right. Now, so and this way, right, they could actually start paying what they call a rising stream of dividend when the profitability starts to increase. Because obviously, right, they paid 40 million for something that's worth 300 over million. Yeah. Okay. So they really know what they're doing because they've been in the industry for so long as well. Right. So they start, building up this over here, and they grew really, really quick. Right, so KMP, which is what they started, ended the year, all right, with 74 million in revenue. All right, so they paid 40 million to buy this entire pipeline, right? And in 97, end of the year, right, they had 74 million in revenue. Can you imagine that? All right, and then revenue started to grow to 429 million, all right, 2 years later, to 1999. All right, so that's where, they start to build bigger bridges over here, and they started this empire which they've created now, which is called KMI. All right, so KMI started acquiring more pipelines here and there across different states. Okay, and that's where they started growing and got bigger and bigger and bigger. So KMI right now has 4 parts, which is KMI, and then the KMP, which still exists, And then there's also a KMR, which is called Kinder Morgan Management. And then there's also another one that's under them called the El Paso Pipeline Partners, EPB. All right. England, Poland, Britain. Yeah, okay, all right. So this is basically acquiring of acquisitions over here in terms of growing from one to something that's so big as it is today. Yeah, okay. So that's a little bit of a background and a history over here. Okay, done. Okay,
I think, yeah.
Yes.
So let me just address Uncle Fu's question from my perspective, lah. Okay. I am a firm believer of this thing whereby what you read in the news now and today, right, has already been translated into the stock prices previously. So, for my view, when you read the news, it should have already been priced in by then. It's just that because of the more widespread number of retailing investors that's available now, that's actually in trading now, you might see some response and reaction from them. All right. So that is why, right, personally, when I do such a kind of analysis, right, as much as I can, I try and use options to buffer in an additional layer of safety for marginal safety for me to go wrong. Yeah. But if let's say, for example, you're going to do purely longing the stock directly, just buying outright using market prices now, then I would really recommend that you do an additional layer of analysis on your own. Yeah.
All right, great. Yes, definitely. All right, now, so what we're doing over here is just highlighting point of views from my part, all right, as well as Jeremy's part over here. But do understand we are also humans. Of course, we make our own judgments and our own mistakes along the way as well. So if you're going to get in on anything, do make sure you make your own judgment and analysis as well. Okay, so give me a couple of minutes, okay? Okay, I'm done. I just need to get a wire because my laptop's energy is dying. All right, okay, now, so, all right, okay, I'm back alive. Okay, now, so let me get to my trade suggestions over here, and then we will attend to some questions if any of you have any. So as we go along, I promised Jeremy to keep this to an hour. We have already broken past an hour again, right? So do us a favor as well. If you have any comments or any questions once I go into the strategy, right, just start posting them. Okay, I'll start seeing them and I'll start answering them after that. Okay, now, so going back to the charts over here, as I mentioned earlier, right, we see the channel over here, right, the channel going upwards. So if you're short term, you can sell, puts or put spreads on them. If you're long term, all right, if you're long term, what I would say over here is you can look to sell a put option, all right, that it's somewhere close over here, right, to the support level that you're seeing, right, the long term support level that we're seeing. Okay, and then look to buy a call after that. Right, so there are various few ways to play it. If you're from a trading perspective, you can continuously generate cash flows and income by selling put options and put spreads in the short term. Yeah, right, short term. Okay, as long as you can get a strike that is below, this uptrending trend line or this near support level over here. Okay, otherwise, okay, if you're looking at more capital appreciation over here, what you can look at over here is possibly a break above 15. Right, so let's look at some numbers. All right. Now, if I'm looking for a short-term play over here, as I would say, the logical one will be somewhere around 14 over here, where you get a safety level, right? So we can't really do something that's expiring in 2 weeks' time. So I'll probably go nearest to August, right? And the August 14 put over here would pay somewhere around 50 cents. All right, I think that's decent, all right? Because if you pay 50 cents, somebody pays you 50 cents, and selling a naked put from a trading perspective, okay, all right, just trading perspective, the deposit requirements is about 20% from the broker. So your requirements on deposit works out to about 280, right? 280 because that's 20% of 14, right? And if you're pocketing about 50 cents on 280, right, you are looking at about 18% return, right? 18% return in a period of 1.5 months, right? 1.5 months. Imagine if, the stock doesn't move, right? And you could repeat the same trade again 1.5 months later, right? And then 1.5 months later. This is quite, crazy in terms of the returns you're looking at. But be aware of the margin risk over here. So do know what you're doing, right? So our community members obviously know what they're doing because this is what we do for, our bread and butter, right? We sell options, so we sell put options. We know exactly how to structure our trades and, cap all this risk that we talk about when it comes to margin calls and stuff like that. Yeah, okay. But if you're joining us and you don't have this knowledge, right, one thing is, of course, to be part of us, join our community, find out how to, right? Or otherwise know exactly what you're doing. Be aware of the risk before you jump in. Yeah, okay, because as you know, we say any investment enrichment sessions or education sessions, there's always risk of losses because investment is related. So do your own risk analysis before making any investments into any suggestions at all, because they are purely meant for education and discussion purposes. All right, so that's a disclaimer inserted over there. All right, now, so moving along, if you want to go something further, all right, to be honest, all right, because again, once again, the stock is not a very expensive stock, which means, all right, with 100 shares, you could start buying it at a cost like $15 over here, right, at $15. One of the plays that you can think about over here is actually what we call the covered call, all right, the covered call. Why do I say that? Why do I suggest that? Look at this, okay? If you buy the stock right now, it costs you about $15, okay? So $15 to buy the stock, all right? And if you go ahead and sell the 17 call option, right? 17 call option for December expiry. So that's about five months, I would say. Okay, 5 months. Okay, you will be paid by someone over here around the cost of, let's say, average 65. Right? So you will be able to collect 65 cents in premium. So if I collect 65 cents in premium divided by a cost price of $15, okay, $15. Okay, now that will bring me 4.4%, 4.3%, okay, returns from the premiums alone. Okay, so I'll be able to generate 4.3% in income returns, all right, by selling the call option today if I buy the stock. So this is called covered call. But you realize the call option that I'm selling has a 17 strike, okay, 17 strike. So when I sell a call option, I have the obligation to sell the stock. So I have bought the stock today for 15.12. So if I have to sell the stock to someone at 17, okay, eventually in December, that means that I still have what I call a capital appreciation. That means I'm able to make profits from the stock. Profits of how much? Profits of about 188 over here, right? Because somebody pays me 17 to buy it, and I only bought it for 15.12. So I'll be able to make another 188 in terms of profits, right? If I divide this by my investment into the stock today at 15.12, that will bring me another 12.4% capital gain returns, right? So 4.3, right? 4.3, right? In terms of income returns, right? And a further 12.4, right? Which can come about if the stock does go up. So if I add both of them up, they'll come up to about 16%, all right, 16% over here come December, which is 5 months' time from this particular investment, right? And even if the stock doesn't go anywhere, if it just sits, right, I'll still be able to generate 4% on it. Here's why I like it. The reason why I like it is also because if you look at my screen right now, right, this company pays a dividend right now of about 2625, right, 2625, and it pays this every quarterly, right, every quarterly. The last payment over here happened on 1st of May, right, 1st of May, which means from 1st of May, right, 6 months from there, right, it is still before December, right? Because if I add 6 months to 1st of May, that will bring me to about November, right, November, which means I'll be entitled to 2 dividend payments before this option that I sell expires, right? 2 dividend payments. That means from dividend as well, right, I'll be able to pocket somewhere around 50 cents, right, around 50 cents as well. So you realize 50 cents is almost close enough to the premium I've collected from selling the 17 call. Right, that means from selling the keeping the share, buying the share, I'll probably be making another about 3%, all right, from dividend returns. Right, so look at it this way: if the stock doesn't move, I get 4.3% from option premiums, and then 3% from dividends. That's 7%, right, while holding on to it, right? Okay, and if it does go up, I get a further 12 point something percent return. So 7 plus 12 will already bring me to somewhere close to 20%. Yeah, right. I think this is a very simple portfolio-based analysis over here for those of you who are joining us, and really just to build a simple portfolio with some great opportunities and decent stocks over here. Yeah, right. So this would be one play we can look at. Right now, the other play you can look at over here is, of course, to sell the 14 put option. Right, sell the 14 put option, which will get you around 130, 135. Right, and then you can turn around. Right, turn around. What I suggest is turn around and buy the $9. Turn around and buy the $9 put option. So basically, what we're doing right now is we're selling a put spread. Okay, we're selling a put spread. Now, why am I doing this? Because I want to use other people's money now to upsell. Right, to upsell my profits. Yeah, okay. Now, so what I'm doing now is I'm starting to show you the upseller strategy, right? The upseller strategy. So by doing this put spread, I take on a risk of $5 because there's a difference in the strike, but somebody's paying me $1 upfront. Okay, now, so with this $1 that I take right now, I'm going to turn around and start buying some options. So here's what I'm going to do. I'll probably buy the 17. Okay, I'll buy the 17 for around 60 over cents over here. All right, and then, I'll probably pay about 10 cents, right, to buy the 2021. Okay. Okay, now, so you see, when I structure this entire thing over here, right, I'll still end up with a 30-cent credit. Okay, a 30-cent credit. Okay, and one of the best thing over here is I've already kept my losses, which means my loss on this trade is going to be $5. Right, no matter how the stock goes, even if it goes bankrupt, I'm only going to lose 5. Right, so I've got to give the broker $5 to get this trade done. Right, and out of this $5, I'm already pocketing 30 cents upfront. That means I'm already profitable right from the start in a theoretical base view. Okay, now, so 30 cents from $5, right? 30 cents. Okay, effectively, right, you're giving the broker only $4.70, right? Because the broker will actually less of what they're required to pay you. So the final deposit you pay the broker is only $4.70, right? Which is what you will lose. So if I take 30 cents divided by $4.70, okay, it's going to bring me about a 6.4% return. 6.4% return in December, provided if the stock just sits. Okay, but here's the thing. Here's the thing, because if by December, right, somehow we get a crazy market rise, okay, and we get a rise, all the way back quickly to 17 and above 17. Okay, let me pull back to my daily chart over here. Okay, so somehow we get a miraculous, oil price recovery, and natural gas prices start to go up over here, right? And then we start to see breakout from this 18-point level. So remember I said if it breaks out from 18, it could go as high as 22, right? Okay, now I'm not saying that it will go that high, but let's assume it happens. Okay, so if it goes up to 22, what's going to happen to your call spread is you're going to realize the maximum profit on the call spread. So in our call spread over here, right, the strike prices have, $4 maximum profit, right? $4 maximum profit. So that means come that time in December, if the stock is at 22, right, I'll be able to close this entire call spread. That means to sell it back to someone, right? And somebody will pay me close to $4 for it, which is the profit level, $4 for it. So that means right now in my pocket, I have 30 cents, right? And I'm capable, or I keep the opportunity to get another $4 if I'm correct. So at the end of the day, I could actually possibly make $4.30 on an investment of $5 upfront, $4.70 upfront. So can you see that brings my total return in about 5 months to a possibility of almost 90 to 95%. Yeah, okay, so the upseller strategy is looking to do this, right? So conservatively, you can play the covered call. If you're just looking at trading it, you could sell, the 1.5 months put options, right, and do it repeatedly. Yeah, okay, you could also structure a put spread, that's fine. Okay, then if you're looking for an upsized return, right, because you're banking on it going up, then you can apply the upseller strategy. Okay, you can also mix and match. Yeah, okay, based on what you're suggesting over here. All right, now, so that's my take over here. That's my take. Okay, let's answer some questions. So if any of you have questions over here, this is the time to start shooting it up. All right, so I have a question over here from Hian Tuan again. Is there any company recommendation for cable wire? Cable wire. Because computer cables are necessities over here. And when you're done, you must look for them. Not that I have on my list. That's a funny one. All right. That's an interesting one. Jeremy, how about you? Not me.
Actually, I think I do have any companies that's actually recommended for cable wires, but I do want to take this opportunity to give a shout out to everybody who's listening to this, right? That I think collectively as a community, right, we do have a very wide, diverse perspectives that's something that we have. Like we have some of us who are working in the semiconductor industries that they have a more in-depth understanding of those. So you do have questions in terms like this company, what's your view, right? I think it's actually fair point to reach out to either myself or yourself, Terence or Jeremy, right, to let us have a look at it. And we really find that they are actually very interesting companies that we can actually structure. We can actually share in a session like this as well. Yeah.
Okay. Now, so Maureen brought up a point over here. Maureen, so the reason behind buying 2 calls, the reason was I clicked the wrong button. apologize for that. All right, because I clearly said I'm going to turn around and buy a call spread. All right, okay, but somehow I accidentally clicked the ask price for both. All right, so I've already since amended the order. Right, thanks for bringing it up to my attention. All right, now, so as you can see right now, actually the initial credit that I can collect is much higher now. Right, I could collect up to almost 50 cents upfront. Right, 50 cents upfront. Yeah, okay, all right. Now, so I've already amended it. So I'm supposed to sell the 14 strike put option and then turn around and buy the 9 strike put option. Okay, and then on the other side, I would buy the 17 call and then sell the 21 call. Right, so it's called sell the put spread, buy the call spread. Yeah, okay, Maureen? Yes, don't worry, I'm not afraid to admit a mistake if I did one. All right, it was a very clear one over here. Yeah, all right. Managing too many things with a light shining in front of me, with the mic here, and then, of course, trying to answer your question. And it's the weekend. All right, welcome, Uncle Fu. Welcome. All right, I'm glad you like some of the trade ideas over here. That's the purpose. This session is actually going to be different from the one that we're launching next. All right, so as what I've said over here, I promised all of you I'll be executing or doing a trade live each and every week in terms of a discussion. Right, so during that session, these trades will actually be tracked for their performance. Right, and we'll be showing you, how we deal with them as we go about. Okay, so I'll be scheduling the first session come next week. Right, so that one is definitely going to be cash flow live with Terence. Right, because each session is going to be discussion on a particular trade, and we'll talk about either selling a put option on it or buying a covered call on it. Okay, so we're going to cover 2 simple strategies. Okay, we're going to take a simple approach and still show you that you'll be capable of generating returns that can shoot upwards towards 20% and higher. It's not a difficult task. Yeah, okay, all right, now, so that's the aim of this session over here. Apart from that, I think I'm actually done with my part of the strategy sharing. And it does seem that nobody really has a question over here, or everyone's still trying to stomach and absorb whatever we shared so far.
Terence, let's go back to Benjamin's question as a wrap up then.
Yeah, all right, now, so if, okay. Yeah, sure, Jeremy, go ahead.
Yeah, so Benjamin, you were asking me earlier, right, what do I think about Pembina, right? So I think in terms of the company, the numbers that I'm seeing, right, it actually shares very similar profile to PMI as well as EPD. But the thing is, right, there's one thing that is standing out, which is the fact that the price book value is actually 1.29. Put it as a perspective, right, on a relative sense, right, you're actually paying about 20% more for the same price, for the same similar type of companies and similar industries, right, where if you're going to do into PPA and Pembina as well.
Jeremy, are you sharing your screen?
Let me see.
Sorry, I think I accidentally clicked it off. So yeah, if you want to share a screen, can you please click on it again?
Let me try again, yeah?
Yeah, good. All good.
Okay, so I was saying, so price book ratio currently is about 1.29. So we look at KMI earlier, we're looking at 1.03, very close to the actual book value itself. So PPA itself is okay, as a company, it's very similar to EPD and KMI that we looked at this evening. But for the price book value ratio, I would just say that in terms of that, I just prefer KMI better. Also on a relative sense, right, I also took a look at Think or Swing platform. The strike prices for PPA, let me switch the screen, yeah. So for PBA, the strike price intervals, we're looking at about 250 each apart. So it's not going to look very much of a difference when you first look at it, right? But I will share that if you're going to negotiate a stock option, right, with price interval 250, it's actually going to be more challenging than if you're negotiating for $1 strike price apart. Yeah, so on these 2 reasons, right, I actually prefer the KMI, still better than PPA. But one of the main things is because why I need the options to be easier to negotiate is because I'm actually using option strategy as a very much buffer in terms of whole fundamental style of trade, buying the company or going long the company. So if you're going to do a direct long stock on the company, I just refer back to what I shared with Uncle Fu earlier. I think it's good to have an additional layer of fundamental analysis, and you can do that then. By all means, you can actually do that if you find that the company is what you're looking for. Yeah.
Okay, all right. Now, so anyone else with any questions before we bring the session to an end over here today? Okay, all right. Now, seems like nobody has any further questions, but can you just let us know and let Jeremy know if you enjoyed the segment that we have brought to all of you today. Do you like the stock idea that we presented to all of you? Right? Is it something that you're interested in over here? If you do over here, let Jeremy know, right? Because he's definitely not a speaker, so being in front of camera over here can be can be uncomfortable for him. Yeah, right now. So do support him, right? Give him the courage and your support. So let him know if you enjoyed the segment over here that is brought to all of you, right? Because he's putting time and effort in terms of preparing the sharing for all of you as well, right? So the same idea as I have over here to bring more knowledge to all of you and to also educate all of you from this perspective. All right. Okay. Great. Thank you, Anthony. Thank you. All right. Thank you. Okay, great, Jeremy. So we have, all right, our community members as well as some who are not, all right, joining the analysis with us today. Okay, great. Now, okay, all right, I think we're done over here for this session. All right, thank you very much once again. As well, please head over to my Facebook page. Please look at some of the comments for names being suggested so far. If you like any one of them, please click the like button and support these people. Right, because they've used some of their brain juices over here to think what's a possible team, right? And since you're attending this, you might want to have the best name for it as well, right? As you share it out with your friends, right? So they can associate with, what they're coming to hear about as well. So, go click on it, all right? And then share it out with your friends as well. Click the like buttons for the best suggestions that you've seen on that list. Okay. If you're interested, head over to our website as well. All right. Join our Project Options Cash Flow to know more about some of the strategies that we've discussed. Just in case you didn't really understand some of the strategies that we talked about. Okay. All right. Thank you very much, everyone, for joining us. All right. We will try to schedule another session next week as well. We'll try to also keep it to the same time and same day. All right. So we'll keep you informed in Telegram channel as well as our Facebook post as well. So always do stay tuned. If you have not done so and shared this video out, do help us click the share button. Share it out over here so we can get more people joining us on board, and of course more feedbacks and more comments and ideas and questions as well. All right. So we also want people to perhaps bring out any blind sides that me and Jeremy may have in terms of our analysis. Okay. So that's definitely welcome over here. Right, we may not always be right. That's why I always say, all to my students as well as to Jeremy. So it's always fine to scrutinize and to ask as well. Okay, if not, thank you very much for being with us in today's session over here. We hope you enjoyed it and it was value for your time. We'll see you next session over here for US stocks tryout. All right, have a great, lovely weekend. Bye, Jeremy. Thank you. Bye.
Bye-bye, everyone.